At what rate should a retiree withdraw money from his retirement corpus so as not to exhaust it prematurely? For a long time, financial advisors in India have used a safe withdrawal rate of 4%, but that was a rule of thumb based on studies in the US market. A recent study titled Balancing Apps, Safe Withdrawal Rates in the Indian Context argues that the withdrawal rate in India should actually be lower. Rajan Raju, Director, Invespar, and Ravi Saraogi, co-founder, Samasthiti Advisors, who are the co-authors of this paper, speak to us about their key findings and their implications for retirees. Do watch this interview to learn more. Good afternoon. It is such a pleasure to have both of you on our show. You have written what I believe is a seminal paper, and I'm sure our viewers will gain a lot from this discussion. So let us begin by setting the context. What led you to think about a safe withdrawal rate in India?
Sure. So thanks, Sanjay. Yeah, why don't you go ahead, Rajan, and I'll take it from there.
Thank you, Sanjay, and it's a real pleasure for Ravi and me to be here. The SWR, the safe withdrawal rate, is something that Ravi had done a couple of years ago, and he had actually, I think his was a seminal paper from an India point of view. And there was no such research available in India prior to this. Most financial advisors and most rules of thumb, heuristics that were out there would kind of show what a withdrawal rate could be. But Ravi was the first person to actually take Bengen's study and kind of replicate it within Indian context. What we did subsequently is just a follow-up, which kind of extended the data series. So we have a couple more years of history. We changed some of the methodology to allow for different forms of simulation to actually happen, which allowed us to become more realistic in terms of how patterns of returns happen over the course of time. And therefore, that was the whole intent of this paper, which was to try and increase the awareness and the dialogue about safe withdrawal rates within an Indian context, which is actually very different from if you were to take a US context, given the fact that our economy is different, our structural inflation rates are different, our rates of returns for the various asset classes are different, and people have different retirement portfolios within an Indian context as compared to a US context. So that's what we try to flag. Ravi, over to you.
Yeah, thanks, Rajan. So, like, Rajan highlighted, I think it's a lot of, those factors which were the key motivation. And also that, as investors and also as financial planners, we are used to thinking in very, very linear terms. Right, we always do projections based on a constant, return, based on a constant inflation. But reality is very different. And, for us at Samasthiti Advisors, when we were working on many retirement plans initially, it was very easy to see that what projections we are doing, in Excel is very different from how actual retirement portfolios are functioning. And that, led us to look at this a lot more closely. We understood that the moment you incorporate volatile returns and not constant returns, and the moment you incorporate volatile inflation as opposed to constant inflation, those numbers look very different from what those numbers would have been under the typical present value, future value framework. And what the first paper did was looked at retirement portfolios from this volatile context, that how will these numbers look like if the markets were to behave like they behave. And the second paper, which Rajan drilled down deeper and made that analysis more robust.
What is a safe withdrawal rate? Could you define it for our viewers?
So, maybe I'll take that. So safe withdrawal rate, very simply put, is that withdrawal rate which you can withdraw in the first year of your retirement and then inflate it each year so that your portfolio will not exhaust before your life expectancy. So that's what the withdrawal rate does. Now, the reason why it's a lot more complicated to calculate this than we generally think is that the moment you want to calculate this rate such that you incorporate volatility in asset returns and inflation, it becomes a more complicated exercise. Because now what you have to do is simulate a retirement portfolio across different returns and inflation and see which portfolios are able to last longer. So in our study, for example, we have done more than 50,000 simulations of different retirement portfolios to try and see what is that withdrawal rate, which will give a retiree 95% confidence that their retirement portfolio will last their lifetime.
You had earlier
If I
Yes,
could
please.
just add to that, I think the important part here is, unlike as Ravi called it, a future value, present value kind of a thing, where there's a linear projection. What a safe withdrawal rate does is actually look at various future states. What happens if the rate of returns were 50,000 different trajectories based upon what we've done in the past? And then from that 50,000 trajectories, it will choose that withdrawal rate, which will give you a 95% confidence that the portfolio will last longer than the retiree. And so intuitively, when one has to think about a retirement, when a safe withdrawal rate, it's like saying, if I have a fair coin and I want to take a bet on it, and there's a tossing of a coin, what should my bet be? Right? If I say I'm going to put let's say I have 10 rupees, and I say I put all 10 rupees into that bet right in the beginning, it's quite likely I'm going to crash and burn. I will not come to 10 sequences before I could win. So the question is, what is that bet you're going to place at every year that allows you to last for 10 iterations? The complication of this is, one, there's an inflation rate that goes up and down, because that inflation rate is constant. From your perspective, you want to have a constant lifestyle, and that constant as a constant withdrawal rate in real terms. So that constant withdrawal in real terms is going to be what is happening to your returns are going to be different from what they influence. Then your even more complexity into the estimation process. So the safe withdrawal rate is a kind of a summation of all this in a probabilistic manner that gives you a good chance. In this case, we've taken 95% chance that it will succeed for the period of retirement. And that's what is really important about a safe withdrawal rate. It has to last despite projected returns in the future, projected inflation rates in the future that vary.
Could you tell us the essence of your findings? How much is the safe withdrawal rate for different types of portfolios in India?
So actually, we have a fairly big, fairly large number of portfolios that we looked at. So we started off with a 100% fixed deposit portfolio, because a number of retirees actually take a fixed deposit portfolio as a conservative portfolio. And then we moved it all the way up to 60% equity, 40% fixed deposits. And then we had it over periods of 25, 30, 35 years of retirement life. Broadly, what we came out to is, for a safe withdrawal rate, somewhere between 3 to 3.5% seems to be about right, depending upon what mix you have. What we found is being 100% conservative and being 100% kind of aggressive from an equity point of view is not necessarily optimal. And so again, it comes back down to good finance theory and investment theory that says you should manage a balanced risk portfolio, which broadly is a 60-40, 40-60, 50-50 kind of a portfolio between equity and fixed income. And so our findings also kind of reiterate that particular process, that for retirees, a balanced portfolio is more important. We also added diversification into it. I mean, the one example that we took was if we added gold into the portfolio. Again, we just took it for one particular value. What we found is that when you have diversified returns, your portfolio lasts a bit longer, which means your safe withdrawal rates can be increased slightly. We also found that initial years, if you had a bad run, then that's going to be very difficult to maintain the safe withdrawal rate, the success rate of the safe withdrawal rate going forward. So poor retiree who, let's say, retired in 2007 with all the corpus that was required, followed the calculations, but then 2008 happened and the market went down an alarming 60% in real terms, that would have been really difficult for the portfolio to succeed. Similarly, in 2020, when the COVID crisis happened, again, when the portfolio crashed in the first year, it therefore becomes important for people to think about first, second, third year kind of sequence risks. Think about a safe. Finally, we also touched upon tax process within the country, where fixed deposits are taxed on nominal returns, whereas actually what a retiree gets is the real return. And we found that if tax for obvious, a retirement portfolio has a higher chance of success with a slightly higher safe withdrawal rate. So there's a variety of threads that we looked at in this. Ravi, over to you.
Yeah, I think, Rajan, you have summarized it very well. And if there's one number, that maybe the audience can take back, given that most look at retiring at 60, and let's keep the life expectancy at 90 years. So essentially, a typical retiree in India who's looking to fund 30 years of their retirement, we would suggest, based on our research, that they maintain 60% debt, 30% equity, and 10% gold allocation. So it's 60-30-10 portfolio. And that would allow them, to have a retirement safe withdrawal rate of 3.5%. So that's the comfort zone. Of course, as Rajan highlighted, based on specific circumstances, if somebody is using a different asset allocation or is looking to retire early or later, our study, has the detailed table of different withdrawal rates that they can use. But essentially, it will fall down between 3 to 3.5% or a little bit higher in some specific cases.
Now, two questions come to mind. One is if you could explain the sequence of return risk. And another question is, a lot of people in India tend to be very conservative. They tend to focus entirely on a fixed deposit kind of portfolio. At the other extreme, you have the younger generation, which is very gung-ho on equities. Could you tell us the risks on both these counts?
Ravi, do you want to go first and then I'll bring up the rear?
Sure. So the sequence of return, I think it's one of the most underrated risk in financial planning, because we simply ignore the fact that it's not only important what is the average return that your portfolio earns, but in what sequence that return was earned. So two portfolios can have the same average return, but they can have very different terminal values depending on what was the sequence in which the return was earned. So if, for example, a portfolio is exposed to lower returns in the initial phases, but then higher returns at the later phases, versus a portfolio where the sequence is actually the reverse. Portfolios which witnessed lower returns during the initial periods will vastly underperform those which had slightly higher returns, even though we can keep the average return in both those portfolios the same. So this is the sequence of return. I think it's very nicely termed because it's called the sequence of return risk. So it's important to look at the sequence of the returns. And like you mentioned, Sanjay, we do come across these binary cases. There is like you mentioned, a set of the population which is entirely dependent on fixed deposits. And as Rajan highlighted, we do have a case in the study looking at withdrawal rates for somebody who has 100% fixed deposit, and that's very low safe withdrawal rates. At the same time, we have the younger population, which maintains a disproportionately higher share of equity. I've had several conversations with investors where young investors where it's been a challenge to get them to open the public provident fund because the typical response is want equity over 15 to 20 year, give me better return. But this completely misses the point that, you need a diversified portfolio. It's important to focus on the risk adjusted returns and not just the return. It's important to have stability in a retirement portfolio because a retirement portfolio has to last you decades. We are talking about 30 to 40 years, for somebody who's young in their 30s, right, with a life expectancy of 90. It's essentially a portfolio which is getting modeled over 50 to 60 years. Now, we don't know over that long period what the future has in store. And to keep all the eggs in one basket, either fixed deposits or equity, would be foolhardy. So a balanced approach is, what we recommend.
So I think in your case, you had found that once you increase the equity portion above 40, then the safe withdrawal rate falls. So could you explain why this happens? Because perhaps in the accumulation stage, you can have a higher equity allocation, but how do things become different when you are in a retirement portfolio, which is in the decumulation phase?
Ravi, could I just have a go at this, because it also refers back to the sequence of return risks, Sanjay. So let's take a person who retires in 2007 with a corpus. In 2007, let's say it was a 100% equity portfolio. So let's try and put both of them together. So the 100% equity portfolio in 2007, by the end of 2008, was almost down by 70%. Right? And that is sequence of return risk, because you compare that with somebody who retired in, let's say, 1999. In the first year, that is in 2000, in 2002. So in 2003, equity was up almost 70% in that year. So you can compare somebody who retired in 2002 and somebody who retired in 2008 with the same corpus, had two entirely different outlooks at the end of the next year. One who's got a super large corpus because of equity growth, and the second who's got a super low corpus because equity has had a significant drawdown. The challenge that you have is that on the day of retirement, you have no idea what next year is going to bring to you. And because you have no idea what next year is going to bring to you, the volatility, which is how violently can returns move, start to make a difference. In the case of India, if I was to look at it, just Nifty 50 fell in nominal terms now about over 50% in 2008, over 20% in 2011. You could have these drawdowns on the year you retire. And that then starts to make a difference to whether you want to hold an all equity risk or not an all equity risk. The next part is not just the first year, but what happens to the second year and the third year and the fourth year. Many of our younger generation have lived in a period of extraordinary equity returns. If you look globally, the last 2 decades have been a period of extraordinary equity returns, even though we've had these significant drawdowns. But let's say we had a Japan-like situation, where for 30 years, equities kind of underperformed significantly. So now again, assume that you're this poor, unfortunate retiree who retired on the day when Japan had its highest high. And then you're going to wait for almost 30 years before you kind of recovered back to that highest high. So therefore, taking equities is something that one has to think about, is what is the volatility of equities. And there is an interesting concept called volatility drag. So an expected return is effectively the average return less the volatility of that return. And that if you have a higher volatility, the volatility will drag down the expected return. So therefore, 100% equity portfolio does work, especially if you are large enough corpus. So let's say you're a billionaire. Frankly, 100% equity portfolio will work really, really well. But let's say you were at the cusp and you had a safe withdrawal rate that was determined by expected returns of equity being slightly higher than what you could afford. And then you're kind of stuck in a position where you may be taking on too much risk, because between the sequence of return risk and volatility, your actual realized returns fall below your safe withdrawal rate calculation. And the older you get within the retirement phase, the less you have the ability to kind of correct the situation. A 70-year-old trying to find a job, alternate employment, is going to be a lot more difficult than if you were, let's say, 65, right? And so it is those nuances that one has to step beyond to start to think about, how do you plan for retirement? Behavioral biases play a really important role here. And for youngsters who only experience the good times, they have a reference bias. The reference bias is only good times. They've never seen a bad time, right? You've only seen low interest rates, and therefore the low interest rate regime has made a difference to how overall asset class returns have happened. So I think one has to be a bit careful. And the older people often refer to the conservative portfolio, which is a fixed deposit portfolio, which on the flip side has inflation that beats fixed deposit returns net of tax. So if you're too conservative, you're kind of losing out on the opportunity of actually getting your portfolio to stay above water. So your corpus then again becomes large. So it's a really nuanced kind of a discussion where you have to think about your own personal circumstance. What is your expected risks that you're willing to take? What are the downsides that you really do not want to have? How much flex you have on other alternative sources of income? And I think what we have tried to do in this paper is kind of give all these scenarios for people to look.
What are some of the typical
Ravi, over to you.
No, I think you covered that well, Rajan.
So we'll go to the final question. What are some of the typical mistakes that you observe among retirees? What are the mistakes they typically make? And after so much of studying, what would your advice to them be?
Okay, so
Ravi,
I
this
think,
is yours.
yeah, I think, retirement is a tough nut to crack, Sanjay. Essentially, what we see is that for people, who are approaching retirement, they shy away from retirement planning because of fear of whether, they are funded adequately or not. And for the young, it is something which is really, really distant. And, they focus a lot more on the more immediate financial goals rather than retirement. So I think one key challenge is how to make both these sets of population understand that it's important to plan. And it's particularly, for both these groups, for somebody who is approaching retirement, it's important that you bring all of your assets into one platform and then you see what is there and what's not there. I think a key, problem that, I see personally in my investment advisory practice is that people fail to look at retirement assets in a portfolio view. So they may have employees provident fund, they may have public provident fund, they'll have stocks, they may have some bonds, mutual funds. It's important to bring all of this together and look at it together in conjunction and see, now do I have all of these assets? How do I develop a nice withdrawal strategy? Taking into account individual withdrawal rules for each of them, taking into account the expected return for each of them, and taking into account, very, very importantly, the exact taxation for each, one of them. You may be withdrawing from that part of your retirement corpus, which is a lot more tax inefficient, rather than using some other part of a retirement portfolio, which is much better from a tax point of view. So all of this clarity only comes when you undertake, and take out some time to look at all of these things in a much more nuanced, manner. And this is, for the people who are closer, to their retirement or are retiring. And for the young, I think many of them, fail to understand that when they look at these typical calculators, and they project what is the kind of retirement corpus that they need, there is a certain kind of disbelief that, okay, do I really need 15 crores, for my retirement, and how am I going to accumulate that, but what we tell them is that this retirement corpus number, which is looking very large and which disillusions you, is not a present value number. We're not talking about 15 crores today or after 5 years or after 10 years. We're talking about, say, 15 crores or 10 crores, whatever that number is, but 20 to 30 years down the line, right? So that number is a future value number, and it's much more manageable when you look at it, that way. And second, people fail to appreciate that when you look at building these large corpuses, and when you look at a fixed amount of investment that you need month on month, that is going to be a big number. But the moment you look at it from a step-up SIP point of view, where you're going to start small, but let's say you're going to increase that monthly investments by 5 to 10% each year, it's a very, very manageable number. So, for both this set of, population, it's a very, very addressable problem, retirement.
Thank you very much. We have had a very engrossing conversation, and I'm sure your paper will have a big impact on the way financial planners do the planning for their clients, and it will also be very helpful for retirees. Thank you very much. It was a pleasure speaking to you. Have a nice day.
Thank you. Thanks.
Thank you very much. Thank you.
Goodbye. Goodbye.